This leads straight to Revelation 13. Hey guys, Britt here. Welcome to End Times Bible Prophecy. We're seeing the beginnings of a banking collapse that will lead the world right into a system indistinguishable from the mark of the beast system we read about in Revelation chapter 13. So it's never been more important to pay attention to what's happening and understand what's going on. In today's video, we're going to talk about what's happening in the global banking system right now, what the proposed solution will be from the governments and central banks of the world, and how this directly relates to Bible prophecy. So guys, let's start right here with this from CNBC. This is from last Thursday. It says regional banks and Jefferies shares tank as concerns about sour loans grow on Wall Street. And guys, we're seeing more and more of this crop up every day. It says shares of regional banks and investment bank Jefferies tumbled on Thursday as fears mounted around some bad loans lurking on Wall Street. And that's an understatement, as we'll see as we go through this. It says the bankruptcies of two auto industry related companies this year have raised concerns about loose lending practices, especially in the opaque private credit market. That's left both the banking industry and investors concerned about whether instances of loans gone wrong indicate a burgeoning crisis. And spoiler alert, yes, they do. It says the latest signs of trouble came when Zion said Wednesday evening it faced a sizable charge because of bad loans to a couple of borrowers. And Zion's Bancor, that's one that Florida Atlantic University, we've been through their banking initiative and how they pointed out exposures to commercial real estate, as well as a number of issues that banks all throughout America have that are troubling those banks. And Zion's has been at the top of the list since 2023 in many cases. It says, despite expecting this was an isolated incident, the bank said it will encourage its counsel to have an independent review. Western Alliance, so this is another bank, Western Alliance then alleged Thursday a borrower had committed fraud. We're going to look at there's widespread fraud being uncovered in these markets that's directly impacting the viability of these banks. It says that rattled investors despite the company saying it could reaffirm its guidance in 2025 outlook. Quote, while we are questioning why all these credit, quote, one-offs, and they're not one-offs because they keep coming up one after another, are seemingly occurring in a short period of time, the reality is that even though these exposures may be, quote, well contained and have a limited financial impact, this is an industry where investors, especially those that are new to this sector, tend to sell first and ask questions later, especially when it comes to elevated credit concerns. JP Morgan banking analyst Anthony Elion wrote in a Thursday note to clients. So here we have bad loans hitting. They're talking about fraud. Well, let's see what that fraud is, because we foretold this 2-3 years ago on this channel that we would see exactly what we're seeing right now. And it would be a reason that they'll push for central bank digital currency. So we had this from Zero Hedge, also from Thursday. It says regional banks crash as more credit, quote, cockroaches emerge. So this is a term used to say if you've got this bad credit, bad loan that crops up, well, usually there are others that are still hidden. And in effect, you're generally not going to see one cockroach. When you see one cockroach, it means there are others that you don't yet see. And that's where the banking industry is right now. These keep popping up, these one-off events. It's a one-off event. This was just here, this happened. What are the odds of that happening again? And then it happens again and again and again. So that's what we're seeing. So this says, shares of Zion's Bancor plunged 12% after it disclosed a $50 million charge-off for a loan underwritten by its wholly owned subsidiary, California Bank and Trust in San Diego. says Bloomberg reports that Zions said in a lawsuit that California Bank and Trust is owed the money from two investment funds tied to Andrew Stupin and Gerald Marcil, among other parties. California Bank and Trust provided two revolving credit facilities to the borrowers in 2016 and 2017, totaling more than $60 million to finance their purchase of distressed commercial mortgage loans. The terms gave the bank, quote, first priority perfected security interest in all collateral, including each mortgage loan purchased by the investment fund. So what that's saying is the bank is essentially saying, we're going to loan you this cash, and in return, you're pledging to us the collateral of these underlying properties, these commercial properties. And if you don't pay back the cash you've borrowed from us, we will then go foreclose on those properties, sell the properties, and repay the money you borrowed with the sale of those properties. That's how we'll look out for ourselves and make sure that we're not going to get stuck with a huge loss because we've loaned you this cash that you can't pay back. This says, but after an investigation, the lender found that many of the notes and underlying properties were transferred to other entities. This is fraud. And those properties have already been foreclosed on or were about to be, according to the lawsuit. So in other words, the collateral the bank thought was there that was going to protect them against not being paid back, it's no longer there. So they have to eat the loss and engage in expensive litigation in the process of trying to get back some of what they've lost. It says, but it gets worse, as Bloomberg points out that Western Alliance also lent money to the same investor. So again, Western Alliance, totally different bank from Zions, but both of these are large regional banks. Western Alliance also lent money to the same investor group for them to originate or buy mortgage loans, according to the bank's lawsuit in August. The outstanding balance of the loan is $98.6 million. Western Alliance found that the collateral was supposed to be backed by a first priority lien, but that wasn't the case. It alleged that the borrower created fake title policies by omitting the senior liens. So again, fraud. So at the same time, the borrower drained funds from accounts that acted as additional collateral, according to the lawsuit. As of August 18th, the borrower held a little over $1,000 in their bank account at Western Alliance, while the required monthly average was $2 million. It says, as if that wasn't enough, Western Alliance also said it has exposure to the collapse of auto parts supplier First Brands Group. Well, First Brands Group has been in the news. What's happening with First Brands Group? Well, this was a large auto parts conglomerate. Many brand names we probably recognize from auto parts stores were part of this, but they took on massive amounts of debt. They were engaged in all sorts of really shady deals, and now they've gone bankrupt. They filed bankruptcy, and many of these banks, again, Western Alliance Group has exposure to First Brands Group. So what does that mean? Well, let's take a look at this email that's circulating around the internet. So this is sent from a partner at a firm trying to figure out, how do we get cash from this First Brands Group? What's there? What are we dealing with? And then I guess the accounting firm that's overseeing all of this. So he says, Wild Team, thank you for your help yesterday in respect of the orders and our clients' comments. We would like to set up a call with you today to ask two questions which our clients need for informational purposes. First, do we know whether First Brands Group actually received $1.9 billion with a B dollars, no matter what happened to it? Because they're bankrupt, and this money is just vanished into thin air, this $1.9 billion. Second, would you tell us how much is in the segregated accounts in respect of the factored receivables as of today? And the response he gets is, number one, in respect to, do we know whether they actually received the $1.9 billion? He says, nope, we don't know. And how much is left in these accounts? Zero. Right? So in other words, massive fraud. The cash is not there. Western Alliance was dealing with these folks, along with others in commercial real estate that have engaged in fraud, pledged the same collateral to multiple banks in order to get loans. Again, we talked about this in the past, that this is when the financial crisis comes, we'll see a lot of this. We'll see all sorts of fraud emerge, just like Bernie Madoff, that fraud emerged during the great financial crisis. We're going to see hedge funds and these other entities we're going to find out were lying to banks and borrowing cash using the same collateral to get multiple loans. And again, we'll talk at the end about how central bank digital currency, they're going to claim that will make sure that doesn't happen in the future. We can have central bank digital currency. It will give us surveillance into the activities of these shadowy figures so that we know, oh no, they're pledging the same collateral for different loans. So we could put an end to that. We could have stopped this, the regulators will say, if we had only known. But we're going to see the regulators know and have known. We'll look at that evidence in a second. But guys, so all of this is leading straight to a digital tyranny. That's what they're going to propose. But what else is happening? So we have this as well. This is from Reuters. It says U.S. banks tap Fed repo facility as overnight rates climb, signaling funding strain. What does that mean? Let's read on. It says, U.S. banks borrowed $6.5 billion from the Federal Reserve's standing repo facility on Wednesday, central bank data showed, and repurchase rates rose, suggesting tightness in meeting funding obligations, with a large net Treasury settlement due this week. That was the biggest daily borrowing from the Federal Reserve since the COVID-19 pandemic, excluding end-of-quarter periods. The standing repo facility acts as a liquidity backstop. In other words, this is when all else is lost and we need some dollars, this is where the banks go. This is the last resort. Introduced in July 2021 in response to the pandemic, the Fed's facility provides twice daily overnight cash loans in exchange for eligible collateral such as U.S. Treasuries. Because as we've looked at before, so what it's saying here is the banks are pledging these U.S. Treasuries. We hold these Treasuries. We're going to pledge them to the Federal Reserve and get cash back. They get that cash back at face value. But as we've seen, according to the FDIC, the U.S. banking system is over $500 billion underwater on these U.S. Treasuries. They call them unrealized losses. But now they're pledging those and getting loans back for the full face value of these things that are not worth what they claim. Says the rise in the repo was unusual, traders said, given that it's not a month end or quarter end when repo rates tend to jump as banks pull away from acting as middlemen due to higher balance sheet costs required at times for those reporting purposes. Quote, this is just more signs that liquidity is slowly but surely decreasing. Nothing alarming yet, right? Now let's underscore yet. And that's his opinion. But if the standing repo facility is continuously tapped, the Fed should pay even more attention, said Jan Nevruzzi, U.S. rate strategist at Toronto Dominion Securities in New York. So guys, we're seeing this is a sign of stress in the banking system. And there is stress in the banking system for many reasons. We've seen these massive unrealized losses. almost $500 billion that the U.S. banking system is sitting on. We have problems in commercial real estate. Now we have massive frauds being uncovered in the private credit markets. This threatens to break much of the banking system and cause bank runs and a contagion. So we'll see here. So let's take a look at this. This is a tweet from Just Dario. Yes, this clip here from back in October 2024, extend and pretend in the U.S. commercial real estate market. So that's the Federal Reserve itself pointing out what's going on with the banks. And Just Dario says, I wrote multiple articles warning about lenders, quote, restructuring toxic loans to kick the can down the road for years. Even the New York Fed couldn't avoid warning about it. He says, but if they force this to stop, the whole financial system collapses under a mountain of losses. Guys, this is why we've talked about the whole global financial system is a Ponzi scheme built on a house of cards, constructed on a foundation of lies. Once the music stops, the whole thing comes tumbling down. So here we have commercial real estate, and we all know the problems that have been experienced in commercial real estate since the pandemic. We have more and more people working from home, not as many people going into office buildings and downtown areas. And as a result, the vacancy rates are much higher than they used to be pre-pandemic. And the maintenance costs are higher, the utilities are higher. And many of these properties were financed on 5-year interest-only loans. Where have we heard that? Great financial crisis. We saw a lot of that happening in the residential housing market. We know how that turned out. Well, now these properties for the last 2 years, they've gotten to the end of their term and interest rates were much higher. So you have lower cash flow on the property. And now to roll it back over and refinance it, it has to be at a higher rate. That's a money-losing proposition. So many of the people who had borrowed to buy these commercial properties are simply walking away and saying to the bank, have the property, but the properties are worth 60, 70, 80% less than they were just 5-6 years ago. And so that leaves the banks with this big gaping hole where they can't recover their losses. So what do? Well, they extend and pretend. What does that mean? It means they go, oh, well, yeah, I know you can't pay this back now, but things will get better a year from now. So we're just going to change these terms. We'll give you another year to pay us. Even if the person's like, I ain't paying you. I'm walking away from the building. I'm not going to pay this back. They're pretending that they will. And the bank regulators are looking the other way because, again, we see right now, this is from Bar Chart, tweet they put out, that office commercial mortgage-backed securities, the delinquency rate is higher and has been higher than what the peak of what we saw during the great financial crisis. So the question is, well, where are all these reported losses that should be showing up on the bank's balance sheet? Where are the bank failures that we should see as a result of this? Well, we have not seen them because of extend and pretend. But the longer they extend and pretend, the worse the problem becomes, because eventually you can't extend and you can't pretend any longer. And we're seeing that with this fraud emerging in the system. The whole system is absolutely rotten to the core and bankrupt. What else do we see? Well, we see regulators, again, looking the other way. That's enabled all of these problems to emerge. So we had this tweet from Macro Edge. It says, the Office of the Comptroller of the Currency is paring down nearly all community bank regulatory measures not required by law, leaving it up to examiners to determine the applicable requirements. Well, why are they doing that? Well, because many of these banks are insolvent. And so they're basically saying, if it's not required by law, extend and pretend. We've just got to hang in there and let this go. And we had this response to that from Endgame Macro. He says, what the Office of the Comptroller of the Currency just did, that's the OCC, just did might sound harmless on the surface. They're cutting red tape for small banks so they can focus on lending. But it's actually a subtle signal that regulators are preparing for trouble under the hood. By scrapping fixed examination schedules, easing model risk rules, and dropping certain reporting requirements. And we've seen this going on for several years now at the highest levels of the federal regulatory agencies when it comes to banks. It says the OCC is giving itself more flexibility to quietly manage stress in the system. When rules become risk-based and less prescriptive, it means supervisors can choose when and how to intervene, which lets them smooth over losses, delay write-downs, and prevent a panic. In plain terms, they're simply buying time. There's definitely historical precedent for this kind of move. In 2008, regulators quietly loosened mark-to-market accounting rules so banks didn't have to recognize collapsing asset values all at once, a maneuver that stopped the bleeding but also hid the depth of the problem. Again, just like we're seeing now, this extend and pretend, it's hiding the depth of the problem. During the savings and loan crisis of the late 1980s, the same thing happened. Exam standards were relaxed to give smaller thrifts a chance to earn their way out of insolvency. Even in the early 2020 pandemic shock, capital and liquidity requirements were temporarily softened to avoid cascading failures. Each time, the playbook is the same. When regulators see systemic cracks forming, they loosen the rules to slow the collapse and give themselves room to maneuver. So while this OCC announcement sounds routine, it's really a defensive move in advance. Community banks are sitting on unrealized losses from commercial real estate and loan books built for a low-rate world. This is a quiet triage move before the patient flatlines. And guys, that is what is coming. We're going to see the greatest financial crisis the world has ever seen as a result of they've been kicking the can down the road, extend and pretend, and it's created this environment rife with fraud. And eventually, they can't kick the can down the road anymore. How about this from Justario? So he has this graph here, this chart from the Federal Reserve Bank of St. Louis. He says banks' reserves now stand at the same levels as when the 2023 U.S. banking crisis started. However, 2 years later, there are 1.4 trillion, with a T, dollars, $1.4 trillion of assets more in the system, signaling that today the system is more fragile than it was 2 years ago when the Fed pulled off the bank term funding program bailout. So guys, we've got a more fragile system than we had back then. To put that in perspective, well, what does that mean? Well, Janet Yellen, who was Treasury Secretary during the Biden administration at the time, she came out at the time and said, don't worry, the fundamentals of the banking system are sound. Banking system is sound and resilient. Everything's great. That's what she was saying 2 years ago in the midst of this crisis. But then she came back before Congress a year later, once the banking crisis the panic had dissipated, and she said, yeah, I'll never forget those days. We were on the brink of a global run on the entire banking system. It was all right there before us, and we had to act, and we did what we had to do. And, we convinced people that everything was fine. And now Justario's saying it's worse today. And he's right. Because, again, this Ponzi scheme, debt-based financial system that we have, it requires ever greater amounts of debt to be taken on If not, the system collapses. We are at the end of the ability to take on that debt, to take on new debt. And what he's saying here is there's another $1.4 trillion of debt assets that need to be serviced. And there's, well, the same amount of cash, which means there's less that they're not going to be. What cannot be done will not be done. It's just a matter of time. It's not a matter of if this collapses, it's a matter of when. And guys, this is not just the US banking system. We see this all over the world. This is global. This is a tweet from Blue Horseshoe who writes, Japan's big banks are losing liquidity fast. It says the latest Bank of Japan data on current account balances shows a clear tightening in the system. And it's most visible where it matters most, city banks. Between August and September of this year, Citibank's reserves at the Bank of Japan fell approximately 7%. Almost all of that came from excess reserves, the free liquidity banks hold beyond required levels. So that cushion has disappeared. It says, when they shrink, funding costs rise and the whole financial plumbing tightens. And eventually, that tightened plumbing seizes up. It no longer operates. And we have a breakdown of the entire global financial system. Guys, that is what is coming. That's what we've been talking about. It says regional banks also saw smaller declines while trust and foreign banks held mostly steady, but the bulk of the liquidity loss came from Japan's largest institutions, confirming that the Bank of Japan's balance sheet taper is now hitting the core of the banking system. And again, we've been warning about the fragility of Japan. It says Japan's liquidity pool is shrinking. The Bank of Japan is quietly draining reserves. City banks are holding less cash and fewer yen are circulating globally. It's the clearest sign yet that Japan's liquidity tide is turning inward, accelerating the repatriation and carry trade unwind themes shaping global markets. What is he talking about there? We talked about the Japanese yen carry trade and the impact that that had back in August 2024. We saw the largest two-day crash in Japanese stock market history, bigger than the Depression. They managed to paper over that. Again, kick the can down the road a little bit longer, but now we're seeing that is not happening. Since the end of July, the Bank of Japan has intervened in their markets 85 times. It's almost a daily basis at this point where they're having to print cash, sell treasuries, bail out their banking system. Eventually, the market's going to root all of this out, and it will be swift and massive. We're going to see this. Guys, the entire global banking system is skating on thin ice. We're on the verge of the greatest financial crisis in human history. We just talked about this past weekend at the Prophecy Watchers Conference in Norman, Oklahoma. I talked about this a week ago Sunday. What is the solution when all of this happens? So when all of this transpires, when we see the stock market crashing, when we see panic on levels higher than what we saw during the great financial crisis, what are the central banks and the governments of the world going to do? They're going to come out and they're going to say, we have the solution. We can restore your lost deposits in the banking system. We can restore the stocks that are missing from your portfolio, from your retirement account. We can fix all of this, but you have to take the restored values in the form of central bank digital currency for your cash and tokenized assets for your stocks. You know, you're going to have a digital ID so we know that you are who you are for your own safety, to make sure that no one tries to defraud you or take your account, steal your account. And we see what the problem was. We see all of these people defrauded the banking system. They pledged the same collateral to multiple entities. And again, as I said, we're going to see another Bernie Madoff type Ponzi scheme emerge as well. And they'll say, we could have stopped this. We would have known when investors handed their cash to this fraudster that the fraudster then took the cash and bought mansions and yachts instead of investing in the securities they said they would invest in. We saw when this hedge fund went to 2 different banks and pledged the same assets as collateral. We could see that in the system in real time through the surveillance capability that we get with central bank digital currency and tokenized assets. And people will clamor for that. They will say, yes, make sure this never happens again. Institute this system. Restore my lost retirement. Restore my lost savings in the bank. And people will rush to have this happen. And guys, this will happen very quickly when it does. Because as we pointed out, a true central bank digital currency, like they're proposing with the digital euro and in the European Union, is an account held directly with the central bank. And as we pointed out, they're trying to institute holding limits on the digital euro right now as they roll that out. That's the main point of debate, because it would lead to withdrawals of deposits from the commercial banking system, making those banks more fragile, leading to possible runs on those banks. But of course, it would ultimately lead to a run on their entire banking system, because it incentivizes people to hold as much as they can in that digital euro account, because the European Central Bank, like the Federal Reserve in the United States, is the central bank anywhere, Bank of Japan, wherever it may be, is the one bank that cannot go bankrupt. So if you have $1 million in payroll at your company held with the local bank that could fail and you lose 3/4 of it under the law, or you could have it all with the Federal Reserve in the form of central bank digital currency, and you have no prospect of losing that from a bank failure. You could lose it from government just simply deciding to confiscate it. But you couldn't lose it through a failure. What are you going to do? And guys, that, have no doubt, that's exactly what happens. Let's take a look at this right here. This is the rules from the board game Monopoly. It says, what if the bank runs out of money? Some players think if the bank is bankrupt, some players think the bank is bankrupt if it runs out of money. Well, that's a very reasonable thought to have. But the bank never goes bankrupt. This is central banks in the real world. It says to continue playing, use slips of paper to keep track of each player's banking transactions until the bank has enough paper cash to operate again. The banker may issue new money on slips of ordinary paper, and they should put money in quotes too. In other words, we'll just make it up. We'll conjure it out of thin air. We can never go bankrupt. Guys, this isn't just the rules for the board game Monopoly. This is the rules for the banking system in the real world as well. So let's take a look at this. If you don't believe me, this is from the IMF, the International Monetary Fund. And they're writing about stress tests and central banks' capital needs. And they state it implicitly right here. It says, unlike commercial banks, central banks don't have universally prescribed minimum capital requirements. They can't go bankrupt because they can always issue their own currency to meet their nominal payment obligations, right? So they can't go bankrupt. They just can print the currency. They can print the dollars, print the euros. But of course, there's a problem with that, isn't there? That's going to lead to destruction of the currency ultimately, which is where we're headed on the other side of this impending crisis. What we're going to see first is massive deflation. So we see these frauds uncovered as we see these bankruptcies occur, and we see these banks start to collapse. It's going to shrink the currency supply as we see these excess credit eliminated from the system. And guys, it's going to be a deflationary spiral on par with the Great Depression. Not as long in severity because, again, they can't go bankrupt. central bank can always issue currency to meet payment obligations. So they will start printing like crazy to bail out the system. And they're going to be in panic mode because they're used to, well, we can print and save the system. I think when this happens, they're going to find that it takes a lot more printing than they bargained for. And it's not going to work at first, and it's going to send them into panic. As we talked about, the greatest financial crisis in history is coming. We talked about this Saturday over on the Substack at brittgillette.substack.com. I delivered this presentation 8 days ago at the Prophecy Watchers Conference in Norman, Oklahoma, and I delivered it again for premium subscribers over at the Substack channel. So if you want to watch that, head over to brittgillette.substack.com. If you want to be a premium subscriber, but you cannot afford it, you're experiencing a financial hardship, you're just unable to afford it, simply direct message me, let me know that. No questions asked. We will gift you a premium subscription. We don't want anyone to miss out on the content we have over at the Substack because of financial considerations. But if you do have the ability to do that, we would appreciate if you would become a premium subscriber. That's how we pay our bills. It's how we're able to put out all this information, dig up all of these details for people. So guys, send me a direct message if you can't afford it. Now keep in mind, I'm a little bit backed up still in the aftermath of my father's passing, as well as the trip that we took to Oklahoma for that conference. But I'm working on this every day, and I should be caught up very soon. So guys, let me know what you think in the comments below. You know, how quickly does all of this unfold? We could still have 2, 3, 4 more years of this unraveling before it hits the crisis, acute crisis mode. Or it could be next week. I have no idea. But it is coming. We're seeing this. Again, things that we've been talking about for 2 or 3 years, we're seeing those things happen. We talked about they're going to uncover these frauds. They're uncovering the frauds. It's only a matter of time. It's not a matter of if all of this happens. It's a matter of when. Make sure that you're prepared spiritually for what's coming. And hopefully the rapture of the church is the trigger that sets all of this off. But we can't be certain of that. We need to be prepared spiritually to share the good news with as many people as possible in the aftermath of the turmoil and the chaos that will come as a result of this financial crisis. So again, let me know what you think. Leave your comments below. And God willing, I will see you on Wednesday.